So I am going to disable the hands for those who could hear me. And I want to share in my PowerPoint screen so that we can start with our webinar. Yes, welcome everyone. I hope you can see my screen. We are continuing with our webinar. We did webinar number 1. Now we are continuing with number 2 so that you will be able to answer question number 2. Okay, myself, I've introduced myself. I'm Faustina Caserera. This is my name. I'm a chartered accountant by profession, and I am a registered auditor. I run a small accounting firm. That is what I do. And also I assist with marking and facilitation for the Law Society of South Africa. So today, okay, and let me take you back to the house rules. So when it comes to any questions that you might be having, you may ask on the forum. So if you ask on the forum, it will be beneficial for everyone because everyone is going to be able to go through the forum and then at their own time, because it is not real time, it is online. So whenever someone wants to see what we were discussing, they can go on the forum and then they can check, and also it will be beneficial to them. And for any admin issues, any technical issues where you cannot download or where you are having the challenge with the system, you may contact Grace Mukuru. I think you do have an email address when she was admitting you. So make sure that you contact her so that you are not behind, or even where you are not able to submit your assignments or where you are sick and you want a little bit of time extension. So you may speak to Grace and then she'll be able to liaise with me and then I'll be able to help you. Our next is we are going to have a look at trust investments. We are going to have a look at correspondent transactions. We're going to have a look at conveyancing transactions and VAT and other taxes. This is what is going to more of like form part of assignment 2, though you find it's an accounting question. So an accounting question will always start from the beginning. So our transactions will start from the beginning. You record in a cash book, you record in a ledger, but the transactions that we are recording then will touch on these topics so that we are able to record them. Okay, before I can move on, I just want to check if we are on par or I am connected. Okay. I am just checking if you can hear me, if we are all connected, and I'm going to lower the hands of everyone so that whenever you have a question, then I'll be able to see that your hand is lowered or you have lifted your hand because you have a question. And for everyone, is house rules, we should switch off our mics so that we avoid any noises. Yes, I'm going to lower. I don't know if anyone has got a question, but I'm trying to lower everyone's hand so that if ever I see where we have a question, then I will be able to attend to a question and then we move on. And also, I just want to ensure that we are recording. Yes, we are recording. Yes, so I'm going to proceed. I hope everyone has joined and we are able to proceed and look, because the major thing for us is that we need to have a look at the question that I sent you, and then we work on it together. So for now, I am going to share my PowerPoint so that we discuss the various items. Okay, I will just share a window. So yeah, the window that I'm sharing is this one. Yes. So hopefully you are able to hear me. And then the next item, we are going to have a look at trust investments. When it comes to trust investments, I think we discussed that a legal practice is supposed to have a trust account. And then a trust account is supposed to be referenced as a section 2. So section 86.1 is the one that prescribes that a legal practice is supposed to have a trust account. And then section 86.2 is the one then that says a trust account must be maintained. So a normal trust account is referred to as a section 86.2, which we discussed previously. And whenever you're opening it at the bank, it should state that it's a section 86.2 trust account, according to the Legal Practice Act. And then today, we are not having a look at that one, though for us to be able to invest any money from the trust account, from the trust account, or any money that is trust money, it is supposed to get into the trust account. And then from the trust account, then we then invest to the various 2 types of investment accounts that are available. So there's a section 86.3. A section 86.3, this is on the discretion of the attorney or the practitioner or the advocate, whoever is having a trust account. Whenever they see that they've got surplus funds, then they open, preferably a call account. Why a call account? Is because the money should be readily available when it is required. As I've indicated to you, money that is kept in a trust investment account, it's that money that is meant for an underlying transaction. So there should be something that is happening. It can be a court case, a civil matter, it can be a conveyancing matter, it can be even a collection matter where you are holding the money until the matter has been resolved, and as a practitioner, then you are instructed to pay. So section 86.3, this is on your discretion of the practitioner. They open it, and then once they open it, the interest that is earned in that account is payable to the fund. So what I said previously, the fund is negotiated with the banks, the banks which are under the Banking Act, which are opened according to the Banking Act. They have negotiated interest rates. So you would find whenever you are investing according to the Legal Practice Act, the interest rate is already negotiated for. Even the bank charges, they are already negotiated for. So basically what you are then doing, you're just putting money aside. And then section 86.4, this one is where a client would say, they give you a mandate to invest, waiting for the transaction to be concluded. So it can be a conveyancing matter. And then at the beginning, you are supposed to pay in a client is supposed to pay in a deposit. When a client pays in a deposit and then they say, while you are holding my money, may you invest it so that the interest then is payable to me. So 5% of the interest that is accrued in that account goes to the fund. So now they've even put it in their rules in the act, so it's known. Even the banks, they have been instructed to have the 5% payable to the bank, to the fund. Okay, and then there is also what is called an investment practice. An investment practice is when a practice decides to carry out investments on behalf of clients. So if a practice has got quite a number of clients who are interested without any underlying transaction to have their funds invested, and then they instruct the practice to say, okay, this is how we want our money to be invested. If it's more than 10 clients, then according to Rule 55.1, then it's more of like becomes an investment practice. An investment practice has got its own rules, and then a practice has to follow, an attorney or advocate has to follow those rules and make sure that it has got a mandate from the client, and also to make sure that they inform the client to say if anything happens to these funds. Say, for instance, you are told to put money on the stock exchange and then the stock that you bought for the client collapses, then you would find then the fund, the legal practice fund, is not liable for any reimbursement of such a loss. So Section 86.3 and 86.4 and also 86.2, which is the trust account, they enjoy the benefit that if ever anything happens, or if there's misappropriation or there's a loss pertaining to the client's funds, then the clients are able to go and claim from the fund. Of course, they've got their terms. It's not like they would automatically just pay. So what we'll do is that I've got a question that I've given you. I'm just going to discuss the various sections, and then from there, we'll go and apply in terms of bookkeeping, how we would apply bookkeeping to these transactions that we'll be having. So our next line item is a correspondent transactions. Okay. So apparently the legal field has got jurisdictions. So it's unlike us accountants. So because of jurisdictions, you find one is supposed to handle matters in an area that they are court, like they are registered to a particular court. So I had, so they are supposed to hold matters there. If ever they happen to have a client in another area, then it means that they have to instruct a correspondent to help with facilitating the transaction. Okay, before I can go further, I just also want to come back to Teams and make sure everything is okay. And I'm going to switch off my camera for now so that probably you can hear me clearly. Yes. So when it comes to correspondence, then it means if you want to, if say for instance an attorney is in Pretoria and then they have a matter in Polokwane and they want their matter to be heard in Polokwane, they've got a client there, and that particular matter, they don't have an office. If you don't have an office in that area, then it means you have to look at, it means the practice has to look for another practice that will then represent them. Okay, so when it comes back to us as accountants, then we have to account for these transactions in a normal way. So normally what happens is that there are rules which are set by the law societies or by the legal practice councils around the fees, how the fees are charged. So they say, if ever you charge a fee, if you are to open a file on behalf of a client, and then the fee that you charge, the correspondent attorney, whatever that you are charging to your other attorney's client, then you have to share. It can be, if the other attorney says no, there's no need for us to share, then it's okay. But if you agree to share fees, the maximum that you can then share would be a third. So which means the firm that is executing the mandate, the one that is going to go do the matter, follow up with the client, attend to the client, they then collect 2/3, and then 1/3 of whatever that they have charged goes to the firm that has instructed them. Okay, and the other thing that we should note is that in whatever that we'll be doing, there will be some VAT implications. So that is where most of our challenges are when we are attempting to our questions. We need to know how to apportion the 1/3 to the correspondent and the firm to retain its 2/3. So the 1/3 would apply to both the fee and the VAT. So that is where the VAT implication is. Okay, so for our questions, what we do, we normally use collection matters because collection matters are kind of like easy to understand. So they become shorter. So in my example, I've got a collection matter that I have set aside, then we'll go through it. And then we've got a correspondent who is collecting on behalf of the instructing attorney. And then we work it out, we bring it into our books and our ledgers, both the trust account and the business account. Okay, and it all depends which side you are on. If you are on the side of the instructed attorney, the way that you record it differently from the way that the instructing attorney would record, because the amounts that one receives differs. So they record according to the money that has been received in their books. Okay, and then our next slide, it's on conveyancing matters. Okay, conveyancing is more of like done by law firms. So it's more of like a legal process. It cannot happen without a law firm. So there has to be a law firm, there has to be a legal practice that is supposed to carry out the legal part of transferring of a property. So conveyancing more of like here applies to immovable property. Immovable property, we are looking at land, we are looking at houses, we are looking at farms. So those are the ones that are affected by conveyancing. So in every transaction you would find then there has to be a conveyancer. In the legal fraternity, there are people who actually go and study to be conveyancers, and they write their board exams, they write their exams so that they are able to then receive instructions and transfer properties on behalf of clients. Okay, and then the process that is followed basically is that an attorney is approached. So it's an attorney or a practice or a legal practice is approached. They are approached by either a seller or they are approached by an estate agent after they've concluded with the purchaser. So they bring in a purchase agreement, and with the purchase agreement, when they bring it in, then they draw the documents that are required. They look at whether the purchaser has got enough money to pay in cash, or they have to the purchaser has to apply for a bond or, other methods of payment, like, selling one property and then collecting from that property and then paying for the property that is being transferred. Okay, so when the ATN receives these documents, he also, from his side, has to draw. There are documents that he draws, and some of the documents he passes them on to the bond attorneys. And he has to receive money, and the money that is received then is received in the trust account. So you would find usually the seller has to pay a deposit while he's waiting for a bond to be approved. So such a deposit is paid into the trust account, and also the charges, the transfer duty, the rates and tax clearances that are supposed to be paid by the firm, and as well as the charges for the fees for the firm are paid usually in advance. So all that money is then received by the firm. When they receive it, they keep it in a trust account. And then us as accountants, we just have to then account for that money and make sure that upon registration, it has been properly paid to the seller, to the estate agent, and to the purchaser, and we have collected our fees. If we are VAT registered as a firm, then we collect our fees. So that is basically conveyancing. So when I will also illustrate an example that we have. I think the question was distributed, and then you will have a look at an example. And then the last one would be VAT. So with VAT, it is a type of a tax, value-added tax. So value-added tax, it's more of like a firm or a company or a business or an individual who is carrying on a business. One has to be carrying on a business which is continuous in whatever that they are doing. If it's supplying of goods, it has to be continuous. If it's supplying of services, then it has to be something that is continuous. So you find a firm has to either voluntarily register for VAT. So when you voluntarily register for VAT, it means we are below the statutory threshold, which is 1 million rands. So if your fees, whatever that you are selling, exceeds 1 million rands, then one is supposed to register for VAT. The VAT does not apply to anyone who is earning a salary, remuneration. So if someone is earning a salary, then they are not supposed to charge VAT. It is for goods and services, like you are adding value on top of what you are doing. Each stage should be adding value. So that is VAT. So VAT, for one to register, one has to be running a business. It has to be continuous. And the minimum that SARS, the South African Revenue Services, would accept to register a firm or a company would be if they've done a revenue or fees of more than 50,000 in 12 months. So if the fees are less than 50,000, you would find they do not register anyone. So if you more of like register voluntarily, it then means once you are registered, you are registered. You can't go back and say, I'm below the threshold of 1 million until you go and cancel. So you have to complete forms and then you go, you cancel. And once you are certified that it has been cancelled, that's when you stop charging VAT. Okay. So most of the services, like us, we are treated as professionals. Most of our services are standard rated. Standard rated, it means, and the standard rate is 15%. So it means in whatever that you are doing, you have to determine your price and you are satisfied with your price or with your fee. So say, for instance, if you say, I am consulting with a client and I'm going to consult for 500 Rand, it's then you would say, okay, that 500 Rand, is it including VAT or it's excluding VAT? So you have to define it. If the client is to pay at the end of the day 500, then we would say that 500 it's including VAT because your firm is registered for VAT. So whatever that you receive, that you charge for, you should ensure then that you collect the VAT because VAT is payable over to the government. And especially for us, law firms, accounting firms, engineers who are more of like labor intensive, you find most of the collections that are done then are more of like directed to SARS. So only if a small percentage of that is retained, probably on goods and services that you would buy that are allowed as input. Okay, so most professionals, law firms, it's standard rate. So when one opens a practice, then one has to decide when to register for VAT. Whenever they see over a 12 months period, they're going to exceed 1 million, then legally they have to register. If they are below 1 million, then they are not supposed to. There is no pressure for you to register. If you want to register, or if you've got a client that is pressurizing you to register, then it means once you are registered for all clients. Okay. Okay, so the next one is the zero rate. The zero rate does not more of like apply to law firms. It does not apply to accounting firms. It's more of like a rate that was put on certain goods. Like if you look at to ease pressure on households, so you'd find things like vegetables, things like bread, yeah, and transport, you'd find they are zero rated so that the consumer does not suffer that much. So they're just trying to ease the pressure on the consumer. It's a way of government controlling taxes and also making sure that the consumers are not suffering. Okay, and then there are certain goods that are exempt, like exempt from charging VAT, certain supplies, like if you check with the Housing Act, if you are providing RDP houses or certain houses which are approved according to the Housing Act, then those properties are then exempt. And also, what else would be exempt? Also financial transactions, like your interest. If a bank is charging you interest, or if you're charging anyone interest, then you do not have to charge VAT because it is considered as an exempt supply. Okay. And then let's look at the VAT terminologies. We've got what we call the VAT periods. So you would find once a vendor is registered with the South African Revenue Services, they are given a confirmation that you are now registered on this day. The firm is registered, or on your individual capacity, whatever business that you are carrying on, you are now registered. So from that day onwards, you are expected to then start charging VAT. So if you do not charge VAT and an audit is carried out by the receiver of revenue, then what they do is that they just deem that the income that you have received is including VAT because it's things that you are supposed to know. And then in that notice, what they then do is that they give out VAT periods. So most businesses, most standard businesses, law firms, professionals, manufacturing companies, which are doing turnover of less than 20 million. So you find the VAT is usually done every 2 months. So one has to look at the letter, the notice letter, and then you check your 2 months period, because they can either be odd periods or they can be even periods. So you would find if they are odd periods, you are looking at submissions where you submit Feb and March together, and then you submit them in April. April and May together, you submit them in June. June and July together. So those are odd periods. And then if they are even periods, you are doing your January to February, the 2 months, you submit them in March. March and April, you submit them just like that. So you have to check with your accountants and also with the bookkeepers if they know, and then you keep up. And you would find if you do not submit within the period that you are given. So if you are given an even period, which is January, February, and then you are supposed to submit in March, you are given up to the last working day of March for you to be able to submit and pay. So if you pay after March, then SARS would penalize you for paying late. So those are the things that one has to look at, because those penalties are quite heavy. You find the penalty is 10%, and then interest thereafter is they charge you according to the prime rate. So they link it to the prime rate, and then they charge you according to the period that you haven't paid. So it's based on payments. Okay, and then another terminology, it's when you are calculating the VAT, when you're submitting the VAT, you would find they've got 2 methods. The first method is the accounting method, or they call it the invoice method. The second method is the payment method, or payment basis method. So the invoice basis method is that every company, if a firm is registered and it's an Inc., a legal practice is an Inc., then automatically, whenever you invoice, you look at your VAT periods. Whether you have collected the money from the client or you haven't collected, you still have to pay over the money to SARS. And then the other one is the one for the payment basis. The payment basis applies to individuals, like professionals like us. We can start a business and then we start in our own capacity, or even as a partnership. So those ones are allowed to wait until you receive a payment. After receiving a payment, and then you pay over. You look at your payment periods, then you pay it over to SARS. The VAT, you pay it over to SARS. So the advantage of payment basis is that the client has paid you and you are paying over. And the disadvantage of the invoice basis is that where the clients delay in paying you, or if ever you have longer periods of collection, like, some clients would say, I pay you in 60 days, and already you have invoiced them. So it would mean from your own pocket, you have to pay over to SARS. And the effect of that is that it causes cash flow problems. Okay, and then the next one, when we are computing VAT, we look at what they call output VAT and input VAT for us to come to the VAT that is payable. Okay, so the output VAT is determined from the fees that the firm charges. From the output, what we after working, what we call our output, that is on our fees that we are charging the clients, that is the output VAT. It's more of like VAT that we are collecting from our clients on behalf of SARS. Okay, so what then SARS does is that they say, okay, on certain expenses that you incur as a firm, you are allowed to collect what they call input VAT. Those expenses are like your computer expenses, your stationery. You look at your furniture. If you buy furniture, they allow that. And your rental. If you are renting somewhere where it's commercial and the practice is being charged VAT, then before you can pay over the VAT that is coming from the clients, then you can deduct that one that the firm has been charged. And then at the end of the day, you determine the VAT liability. That is what you submit and pay over to SARS. Okay, so when it comes to input VAT, you would find there are certain things that are not allowed to, like you are not allowed to claim VAT from certain purchases. Say, for instance, entertainment. You go, you eat from McDonald's, or you go, you entertain clients, you go for holiday, for leisure, all those things, you find the VAT usually, it's according to the Act, it's not allowed. And also for any supplies like your groceries for the office, for the staff, if you buy a microwave for the benefit of the staff, or anything that you buy which is not production, but for the benefit of the staff, then you would find that VAT that is in those purchases is not allowed. And also the other big thing is the purchase of passenger motor vehicles. So you would find if a firm is to buy a passenger motor vehicle for it to do its courier or for ferrying its staff, transporting its staff members. So the VAT in that vehicle, you'd find it's also not allowed. The only VAT that is allowed on vehicles, it's on bakkies, single bakkies, as well as on trucks. Okay, so that's VAT. And then the other types of taxes, there's pay as you earn. Pay as you earn, that is when a firm is employed and then the employees are earning above the threshold, and then they have to collect, and then from those collections, then they have to pay over. So that is pay as you earn. And then the other one is income tax. Income tax is applicable to every business. Okay, income tax is applicable to every business. So the idea of starting a business or the idea of starting a practice is for one to make money, to make a profit. So at the end of the day, you would find in a practice, when a practice is making a profit, 28%, if it's an incorporated, a registered company, 28% is payable over to SARS. And of that 28%, they've got payment terms. And the payment terms are called provisional tax. So one is to every 6 months calculate the profits estimate for the year, how the year is going to vary. And then if they see that there's going to be so much profit, the first 6 months, then they pay towards the 28%, half of that, they anticipated to pay half. And then the second 6 months, so usually the year that SARS looks at, they look at a year that starts from March, and then the 6 months get to August. So in August, you are supposed to pay something towards income tax, and you pay it through provisional tax. And then another 6 months, which is February, to make up a year, then you pay in the second payment of the provisional tax. So if you combine the two, you prepare your financial statements, combine the two, and then you submit over to SARS. Then they look at how much have you paid and how much, according to the financial statements, are you supposed to pay. If ever there is a refund, they refund. If ever there is something to be payable, then they pay it. Then the firm pays over whatever that is payable. Okay, so income tax applies to everyone. it's individuals. If it's an employee, then they paid through pay as you earn, then they do their returns at the time that SARS opens up. So the employer would provide them with a certificate, which they call an IRP5, to say you can do your taxes, and then they can submit. If it's a sole practice where a person starts their business, their practice in their own individual capacity without registering a company, then they are expected to prepare financial statements, capture their books, prepare financial statements, show the income, show the expenses, and then whatever that is left, which is the profit, then they're supposed to pay tax. Like what I've said, how do they pay tax? Through provisional tax every 6 months. So in such a case, then that individual or a partnership, even a partnership does the same. They have to register for provisional tax. After registering for provisional tax, then they pay over to SARS. If it's a company, it is the same concept. The same concept, a company. And the thing with a company is that a director is treated as an employee of the company. So a director has to have a salary. Or if a director does not take a salary, then the only way that they can take money out of the company, which is recognized by the taxman, is through a dividend. And if they take it through a dividend, then it's subject to a dividend tax, which is 20%. So usually a dividend tax, what would happen is that you prepare your financials, you pay your income tax, you are left with a profit. After a profit, then you declare a dividend out of that profit. The company withhold 20%, and then they pay it over to SARS. So you'd find a dividend is a bit on the expensive side. So one has to balance, because if you look at it and you compare with a salary, so usually a dividend is a bit on the expensive side. But yeah, it's a decision that one has to make, you know, because we live in a world where we are governed and then we have to pay our taxes. Okay, thank you. I think I have covered the material, and from now on we are going to have a look at the example, the question that I've sent over, and then we work it out and see if we can come up with a result. I am going to give this is 4:15. Can we take a break? Probably a 5 minutes break. Those that want a break, can you show by lifting your hands so that I can come off? We take a break and then we resume probably in 5 minutes or even 10 minutes. And then we start with the example. Okay, so we're on for a break. Let's take a break. We'll come back at, let's come back at 5, and then we will prepare, work on the example. Thank you.